Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Bobby Sheth of Salt Creek Capital, a prolific sponsor, 12 deals in 4 years. I thought this interview had a ton of gems. Max, did you come away with any that you thought were particularly valuable?
Lots. And I think prolific's a great word, Will, because just the volume of transactions that Bobby and Salt Creek Capital have done over the last few years is impressive. There's a lot of nuggets in this one. And one I want to focus on is the way that Bobby and his group create value. And he mentions that they stack rank initiatives for these companies early on. They figure out what is the low-hanging fruit. How can they make the most impact as quickly as possible? They don't go after everything. They go after, say, the top 3 and focus on those, because this group strikes me as a group that is a little more traditional in terms of hold period. They focus and function more like traditional private equity, it sounds like, in entering at a reasonable multiple, fixing low-hanging fruit type items, optimizing the business, and then exiting on schedule is what it sounds like to me. He also touches on EBITDA arbitrage breakpoints, and that's kind of a concept that's, we don't all know what those breakpoints are, and I think they fluctuate over time, but he gives a great roadmap on where those might be. And again, I think that fits into Salt Creek's objective of kind of, getting in, getting the work done, and getting out, and getting returns. So lots of nuggets in this one, like I said. So a great listen.
Yeah, I love the stack ranking thing. And one thing I'll add to what you observed there, Max, is how he talks about the way they rank those is based on, these are basically the levers to pull in the business to improve it, is based on 2 things: the probability of success and speed. So which things can be done most with certainty and quickly. And those are the things that they hit first.
Keep it simple, stupid, right?
Yeah. And it is. Nicholas,
I like that one as well. And he talked specifically about how it's better to get quick wins than focus all your attention on a 3-year transformative project. And even though a transformative project can be just that, right? Transform your organization for the better. The quick wins, he argues, gives you momentum, builds culture, and builds a culture and just a mentality around winning. And so by focusing on things that you can accomplish in the short term, you start what is hopefully then a series of success stories that get you to a better ending point overall. And the other aspect I also wanted to double click on there, Max brought it up, is what Bobby called zone skipping.
Yeah.
And so you have these zones of valuations, and this is, I think, foundational in the lower middle market. The lower middle market is all about taking unsophisticated businesses and make them sophisticated for the next buyer. And a lot of that is correlated to size. And so if we break that down a little bit, and Bobby does this in the episode, I think the breakpoints are around 2 million of EBITDA, and below that you will have more of the searchers who go after it. It's quite hard to find lenders just because the check size is too small, maybe with the exception of SBA loans. Will, you know this world very well from acquiring Minds and the self-funded search world. You don't see it as frequently in the independent sponsor world because the deals are simply too small to lever up or are not worth the time because they're subscale. From 2 to 5 million, these are still founder-owned businesses when they transact, which means they lack sophistication, they lack depth in the management team. So this is where the opportunity for most independent sponsors exists, especially with the first, call it, handful of platforms. This is where you will see a lot of sponsors. And if they can get the EBITDA from that range and into the 5 to 10 range, you earn an arbitrage where the multiple goes from, call it, 4 to 6 to more like 5 to 8. And between growing your company and EBITDA and expanding your multiple and levering up your business or your acquisition on the front end, this is how you generate really strong returns. And then the last tranche he talks about, which is probably the upper limit in the lower middle market, is the $10 million breakpoint, which is truly where sophistication is already in place. You have a full team and processes and probably multiple locations. So I really enjoyed him talking about that. It's not necessarily new to us or our listeners, but it's so important to just have top of mind every time you look at a deal. And Bobby says that just getting to 5.1 makes a big difference, right? You don't have to get to 6 or 7. Just go from 3.5 to 5.1 specifically, it says, which it says humorously, but I think it underscores the point.
And it underscores the point that not every additional $1 million of EBITDA is created equal. There's a lot more value in going from 9 to 10 than from going to 10 to 11. If you can just tip into that zone skipping thing was such a good distillation of this concept. Like you said, Nicholas, I don't think this is news to people, but to have it really tightly condensed into this little phrase will be really helpful to use as shorthand. Well, let's get to it. This is Bobby Sheth of Salt Creek Capital. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Boston-based Bobby Sheth is a prolific dealmaker who's part of the Salt Creek Capital ecosystem. Banking, HBS, turnaround consulting, and mid-cap PE. Bobby spent the first decade of his career honing the deal-making and operating skills he now brings to bear. COVID was a turning point for him. He decided to go down market at that point, finding the lower middle market to be more entrepreneurial. He's closed 12 deals in 4 years as an independent sponsor, focusing on sourcing and deal execution. Bobby, what is needed operationally, logistically, to be able to execute so prolifically in your first 4 years as a sponsor?
Well, first of all, Will and Nicholas, thanks so much for having me. I think it's a great podcast you guys have come up with, and I think it's a very timely topic of conversation. So you're correct. In 4 years, 12 deals is a lot, and candidly, I'm not sure I got the amount of sleep I probably would have liked in a perfect world. But I think doing 12 deals in 4 years kind of, to me has laid out a dynamic where I can kind of think about, what's really important and what's not really important. And I can kind of extol the virtues of Salt Creek in a world where, a lot of what they bring to bear really has allowed me to get a lot of transactions done over this period of time. And so it's been just a busy time, but a very productive time.
Great. Well, we're going to hear all about what you've learned, how you see the sponsor market over the course of this conversation. But let's start with looking at one of your deals in women's intimates, of all things. And the reason we start there is because it relies heavily on imports from China. So here you are at the front lines of the trade war that we're all having our head spun about. What does that feel like? What can you tell us about that, recognizing that when this airs a few weeks from now, we might be in a different world yet again?
Yeah, well, candidly, there's a lot of parallels with just generally investing in the lower middle market and independent sponsor type deals. But as it relates to this women's intimates business, they are clearly at the center of what is a all-encompassing trade war. And just to give the reader or the viewers and listeners a perspective, much like many industries, the vast majority of lower end, and we're not talking Victoria's Secrets or that caliber, but things that are sold at the discounters or Walmart or Target or that level, the vast majority of that is actually today produced in China. And so how does that dynamic affect businesses which source all of their material from China and then sell into the retail channels in the U.S.? I would say, it's been a whirlwind. I would say that, whatever people kind of thought kind of going in, I would say that has been turned on its ear in a variety of different ways. My major takeaway is that you can't adjust your strategy on the fly. So it's the kind of keep calm and carry on approach that many people will talk about. But there's just so many moving parts that changing things on a dime, I think, is actually damaging to the business. So what we've done at this business is really kind of focus on brass tacks, work with our customers to explain the situation and how it affects our price points. They are obviously pushing back on price increases, but everybody kind of understands that there's a short-term phenomenon if this continues. And then as time goes forward, if this level of tariffs exists for 6-12 months, the world's going to have to adjust. But for right now, people are kind of buckling down and seeing how they can utilize inventory, how they can utilize alternative supply, how they can kind of stretch what they've got, how they can, maybe think through, historically what was somewhat fashion driven. How do we just focus ourselves on basics, et cetera, et cetera. All of these kinds of SKU rationalization and inventory management tricks, I think, are really going to be top of mind for the next 6 months.
And tell us a little bit more about this business and about this deal, size and non-tariff related. Just give us kind of a picture of this case study.
Yeah, so it's a business that's doing, call it 40 plus of revenues and approximately $6.5 to $7 million of EBITDA. So, I would say a relatively high margin business. By nature of the industry they're in, they have some customer concentration. So their end markets that they focus on are really kind of the TJ Maxx's, the Ross's, that type of customer. And the business was purchased from a woman who founded the business probably about 25 years ago. Started it in her garage, really with a single sewing machine, and now has kind of built it to where it is today. She was looking to kind of move on with her kind of retirement plans, and her sister had been her kind of second in command and driving a lot of the day-to-day, and so we backed that sister in kind of a leveraged buyout or recapitalization transaction.
Tell us a little bit about how you found this deal initially.
Yeah, it was kind of an interesting dynamic, as I'm sure a lot of your listeners know. The number of down the fairway banker run processes that don't have any bumps in the road as an independent sponsor are few and far between, right? Every single deal, and I've, as I said before, done 12 of them while I've been at Salt Creek. Every one of them has a unique story to it. So in this situation, I think there was a banker who I knew pretty well, who understood some of the challenges with fashion and retail and the types of buyers who might be interested in this kind of business. I went and had an early meeting with the owner and her sister. Really kind of felt like it was a unique value proposition as a business, but it wasn't going to be a straight up into the right type business. There was going to be some periods of dislocation. You were going to have to deal with, whether it was a new Trump administration, which is what we're dealing with now, or some cyclicality, or some dynamics with customers around pricing. But we knew there were going to be some invariable ups and downs in the business. And so, having worked with the seller and her sister, I think they got a lot of comfort in that we'd been, very prolific in working with sellers who kind of had a similar dynamic. Somebody's moving on. How do we support the business through in this case, not a generational transfer, but a sibling transfer, I guess, to some extent, coupled with what else did we need to do to really build this business from the epitome of a family-oriented business to one where we're kind of a private equity-backed hardened business.
So you found so it's a bankered process, and this was your 12th deal, right, at Salt Creek?
This was my 11th deal, I believe.
Okay, so one of the most recent ones, and it closed here fairly recently with the new administration. And so when you found this, you negotiated and you closed it. Can you tell us a little bit about the interplay with Salt Creek? Because when you started as an independent sponsor 4 years ago, you didn't start solo. You joined more of an established infrastructure system there, right?
Yeah, no, absolutely. And Salt Creek has been instrumental in my success. And, I think I would, in a nutshell, I would call Salt Creek a little bit of an independent sponsor in a box approach, right? And so what, a person like me gets is access to a variety of things that are candidly take time, effort, and elbow grease to develop on your own, that Salt Creek has kind of developed a format to allow deal makers to kind of benefit from and be more prolific on the back end. And so, I'll give you some examples, but, Salt Creek has spent a lot of time and money developing a sourcing database, right, where there is just a treasure trove of transactions and companies and banker sims and other things that people can look at over the last 10 plus years. And as we all know, deals sometimes just don't get transacted, but 6 months, 12 months, 24 months later, suddenly the makings are there for a successful transaction. So utilizing that database of history is actually very helpful to us. We have a junior team, right? And so this goes back to one of Will's earlier questions of, well, how do you do 12 deals in 4 years? And I think that's a valid question. And part of what I benefited from was the infrastructure that Salt Creek brings to bear. So I view, almost 3 buckets of stuff, right? There's the stuff you really need to be involved in. There's the stuff you kind of need to be informed about and almost get the negative, if something's wrong, let me know. And then there's the stuff which is kind of every private equity firm has this, but what I'll call the boil the ocean type stuff, which is, something people need to do because an investor wants to know about it, or your investment committee wants to know about it, or whomever.
Right. You mean the admin stuff?
The admin, but also like a lot of the questions that are maybe not super core to your thesis and are maybe just a tangential thing where you have to cut a lot of data, cut it a bunch of different ways, can be sometimes very instructive and eye-opening. But what I find is there's also a lot of times where you're just spinning your wheels, not getting a lot.
Of the 12 deals, how many of them were add-ons versus new platforms?
They were 10 of them were platforms and 2 were meaningful add-ons. I've done some smaller add-ons, which I'm not including in that number.
Right.
But it's 10 platforms and 2 meaningful add-ons.
Yeah, that was my impression. It was predominantly platforms. And so the most recent one, or one of the most recent ones, was in women's intimates, $40 million worth of revenue selling female underwear. What kind of volume are we talking about with that kind of revenue?
Yeah, so we did, without trying to get too specific, but I think it's important to kind of characterize kind of what we do at Salt Creek and really where I spend my time. Really is kind of on the value orientation side of things, right? So we are not, and I always characterize this to sellers as, we're not the types of buyers, nor am I the type of investor who wants to go pay 9 times for a super quick growing, 3 levels of management bench strength type business. That's just not where we live. We live in the world where it's a business which typically needs some TLC. And so we had something around 3 times cash at close. And then we created some bells and whistles. I call them bells and whistles, but really it's structure, right? Whether it's notes, contingent notes, earnouts, employment agreements, all the typical tools to kind of give the seller additional upside as we execute on our strategy. And so, what that does for me is it limits some of the risk, allows for a structured transaction that makes a lot of sense in an independent sponsor context. We don't over-lever it. We give ourselves lots of runway for whatever inevitable bumps you have in the road. But then, if things break right and we are able to kind of create this institutionalized business, there's lots of upside for us and the investors.
But where I was going with this volume question was, although it was a little funny perhaps, this must be one of the biggest players in the industry. I mean, just doing some quick mental math, $40 million worth of niche underwear or one gender underwear, right? So here you're getting one of the market leaders and you're a value-oriented investor. Is that the core tenet of your investment philosophy?
It's one of the core tenets of our investment philosophy for sure, right? Where we are buying in a niche industry leader that has a real reason to exist. It has a, if we were to, the mental exercise I typically go through is, if this business disappeared tomorrow, who would be hurt? And there would be people hurt, right? There would be customers who miss us, vendors who miss us. There would be a need to fill that hole. There's lots of businesses where that's not true, but we try to focus our time on businesses where we think that there's a value-added edge. So yes, they are a market leader. Their customers really rely on them for their design services, for their ability to source internationally, for their ability to kind of understand trends, for their ability to kind of bring a whole suite of services, kind of, for lack of a better term, a planogram type approach to that segment of the market.
You touched on value, Bobby, and that was something that we spent some time on in the pre-call, where you see a lot of sponsors go wrong, maybe because of naivete, over-optimism, trying to get their first deal done. So can you speak to that? And before you do, just also, I think it's important to say more about what your kind of other role is at Salt Creek, working with sponsors now coming kind of up under you in a kind of quasi-coach capacity. So define that for us, and then to my question about valuation.
Right. So at least on the coach question, there are only so many hours in the day, right? And so I think alongside some of the Salt Creek partners, one of the things we realized was to create scale, you need to bring along other investors who might be able to do some of the heavy lifting, but might not have the experience set to really successfully run down transactions and close them, without a little bit of help, guidance, et cetera, et cetera. So the profile of what we've done at Salt Creek is multiple people are kind of what I would call independent sponsors, but I work kind of in a team with them where they've got kind of a junior set of resources that come out of the Salt Creek environment, then that independent sponsor, and then they work with me, who will help on structuring, valuation, seller relationships, kind of a lot of the high leverage points in getting a transaction done. And so I've been doing that for about a year and a half now. I've gotten multiple transactions done in that environment, got a couple more under LOI right now. And I think it's just a really great opportunity for people who are at a stage in their career where they're like, hey, I know a lot of the brass tacks of how to get a transaction done, but what I really value is another kind of experienced person kind of sitting with me and really working through the nitty-gritty of a deal and focusing on what will actually create value in the long run.
And so you have seen, you see patterns there in some of these folks about what missteps that they make or almost make, and you direct them around. So talk to us about some of those. And valuation, I think, was one.
Yeah, let's start with valuation, because I think that's a standard question that literally comes up with pretty much everybody we talk with, right? And so, to give you a stylized example, a form of question I always get is, hey, I would have bought this business at $100, and if it's going to $1,000, what difference does it make whether I pay $100 or $110, right? That's a very common trope in private equity. They're like, well, the real mistake is not buying it at 100, but missing out on the upside from 100 and 100 or 110 to 1,000. And mathematically, that makes sense, right? I totally agree with them. I think where people overestimate or over-index is they focus on the upside, and particularly in these lower middle market businesses, it's very rarely a straight line up. Models might show that it's a straight line up, but there's always the inevitable kind of Mike Tyson punch in the face that you're going to get. And, explain to them that we need to think through things, holistically, but also with the view that, if something goes wrong, which inevitably will, how do you course correct? And if you overpay, it becomes much, much more difficult to course correct kind of in mid-stride. And so the independent sponsor models that I've seen that have been most successful have been ones where they're disciplined about price. They have a value creation thesis, but they've got flexibility around that thesis to say, okay, well, we might have a bad year this year. Okay, well, if that's the case, maybe I don't spend $1 million on CapEx, or I might not invest in those 3 salespeople, and kind of let time kind of eventually settle to that happy medium where you can then restart your growth or value creation thesis that you developed at the start of the deal. And so that's just something we see all the time with people who are early. They're like, I think this business is going to be the next Google. And the reality is very few are the next Google. And you've just got to be able to position yourself in a world where you can be successful with the inevitable ups and downs that you're going to see.
And so this point on valuation and why to be careful not to overpay is less about having the delta between what you pay and what you sell be as much as possible. Of course, that is the game. So let's not dismiss that totally. But it's more about downside protection, really, and giving yourself room for an inevitable troughs in that bumpy line to the top.
Yeah, in a levered environment, and again, most of these businesses that independent sponsors go track, they don't have the experience of living in a levered environment. And what that leads to is discipline, a need for discipline, but it also creates volatility. And by having, a appropriate purchase price, good alignment with your management team and your sellers, and a situation where you haven't overpaid, where you're kind of trying to hit that home run when, a slight downward trend kind of blows your deal up. Having all of that set up for longer term success, I think, is really important, and something that I think independent sponsors sometimes underestimate the value of having that flexibility and that extra time to deal with the ups and downs.
I love this phrase you just used, living in a levered environment, and how many times people coming into this world have never lived in a levered environment. You just said it beautifully, but is there anything more to say about what that environment feels like, what it looks like mathematically, with the realities of it that are different than an unlevered environment?
So somebody might say, hey, if I have, I'm going to make up numbers, but $3 million of EBITDA, and that falls to 2.5, they say, well, that's just not that much. The problem is when you go pay 7 times for that $3 million EBITDA business, likely you've got $10 million or $10 million plus of debt on that business. A lot of that incremental cash flow is sucked up by your lenders. And so in a world where slight deviations, which we all acknowledge are going to happen in small businesses, do happen, what that leads to is a disproportionate impact on your ability to manage through it, right? So that 3 to 2.5 trend means all your cash flow is now going to your lender, and now you're sitting there saying, well, how do I course correct? My course correction might be I need to go hire a salesperson. I'm just making that up, obviously. But if that's the case, now I don't have the free cash flow to go hire that salesperson. What do we do? And so living in a levered environment requires, when you're talking about family-owned businesses, typically they don't have that dynamic, and they don't have the financial model to absorb that. They kind of think about everything very deterministically from point A to point B, with the reality being there's almost a sine wave around that point A to point B straight line, and being able to manage through that sine wave is really important.
What is the right amount of leverage there then? Because even if you buy a company cheap, you can still put 3 turns of EBITDA on it, right? So
you absolutely could. I'm going to give you the unsatisfactory answer, which is it depends, right? And so every business has its own set of unique dynamics, right? So if it's a contractually based revenue stream that has high recurring revenue and contracts, that is a different leverage profile than a business that is, project based, that kind of bounces depending on business cycles or building cycles or whatever it might be. Those two will have different leverage profiles. But if you just look at the 60 deals Salt Creek has done in its history, I would say even though some of those have, I mean, without spilling the beans, everybody has bad deals. Some of those haven't gone great. But even in that world, we kind of view something in that 3-ish times range is kind of where we like to max out. Maybe it gets up to 3.5. We're never levering businesses 5 times, right? Because we just think that creates a situation where you're almost setting yourself up for failure.
And you guys have been doing this for a while. Do you see more or less discipline around valuation as the independent sponsor space is maturing?
Great question. I think that you're seeing different discipline. So what I see is a lot of independent sponsors, what they do is they view the banker storyline as the storyline they need to go hit, right? So inevitably bankers are marketers, right? So they're going to tell you, hey, this business should trade for 8 times. Now, the reality of the situation is, having now lived in this space for 10-ish years, kind of in a variety of different roles, very few lower middle market owner-operated businesses trade for 9 or 10 times. And so the world we kind of focus on around value is one where we think about, how does this business survive in a downturn? And, spending 3, 4, 5 times is much more, or 6 times is much more in our strike zone than going above that. And what I found a lot of financial sponsors or independent sponsors do is they go chase those deals and they almost fall in love with those deals. And then that leads to a set of bad dynamics on the back end. And so while I think that's true, the other thing I think is true is investors are getting smarter and smarter, right? They know there's a whole lot of good independent sponsors out there. And so what those investors are doing is they're saying, hey, go find something, come back to me. They look at it and they say, oh, we've seen this story 4 or 5 or 6 different times. It's not a 7 or 8 times business. It's a 5.5 times business. And that's where we need to play. And so it inevitably ends up as a broken deal. So answering your question in 2 ways, I think they overbid sometimes, but then it also leads to a lot of failed transactions in kind of the lower middle market.
I agree with you. What I hear is that valuations are probably less disciplined, and there are probably 2 main reasons for it. One is there's more capital available, so it makes it easier to make a deal happen. And the other would be that some of the sponsors coming in now, or some of the sponsors that have been around for a while, add a lot of sophistication. And so they have more strings to play on, more ways to add value, and hence it's easier for them to rationalize a higher valuation on the front end.
Yes, I think that is definitely true. I think that there are more levers they can play. I think when you say I think the number of independent sponsors who have been as prolific as Salt Creek is relatively small. I don't think there's many out there who can claim they've done 60-ish transactions in their history. There are more and more, though, that are becoming very acquisitive. And as they do that, they get experience, they get resources. And so, yes, I do think they can lean a little bit more forward in their heads. But I think the ones that have been most successful, honestly, are the ones who kind of stick to their knitting, honestly. And the ones who say, hey, there are a few things we do really well. Let's focus on that. And again, I think, at least from my perspective, the ones who've been financially disciplined are the ones that are most successful in the long run because they just don't overpay.
What are some examples of sticking to your swim lane that you have seen?
Yeah, I mean, there's, a great example is when I give the Salt Creek, I'll call the propaganda-laced overview, one of the things I always tell them is, I am not, and Salt Creek is not typically an investor who invests in cutting edge technology in businesses, which have like a SaaS or ARR type model. We're also not guys who spend time in the depths of healthcare. We're not guys who do oil and gas. And the common thread around all of those, I think, is if there are a lot of really smart people who spend their entire day focusing on those industries and those types of businesses, and that falls to me as an independent sponsor, it's the age-old quip. If you don't know who the moron at the poker table is, it's probably you. And we really live that. We believe that if there's just a lot of real money and really smart, intelligent people who spend all their time focusing on it, and they're passing, and we're the winners, we're probably doing something wrong.
So how smart industry is something that you look at. Because if it's a particularly smart industry and an opportunity has filtered down to you, the smart money has passed. So what are some not smart industries? The ones that you've invested in, I guess. We can go look at your deals.
Yeah, that's a fair way to put it, although I'm sure the sellers who sold to me might not be super happy with that description. So, where I think, Salt Creek and where I've lived is what I'll call the old economy world, right? So that's manufacturing, niche manufacturing, consumer products, building products, industrial services. But we're of the view that there's just a lot of really smart people who spend all of their time chasing a niche in SaaS. And if you just were to do a ChatGPT search of give me all the lower middle market private equity firms who want to go buy a $5 million EBITDA business, which does cybersecurity, there are a cajillion of them. And and so how do I possibly compete with that when I just at most will dabble in cybersecurity? So we spend our time with things that we think have broad linkages across industries and markets where a lot of specialized knowledge isn't necessarily required to be smart and be thoughtful, right? It's the same set of stories, the same set of challenges, the same set of inflection points that you see over and over again that we like to invest in and help companies through.
Great, Bobby. Returning to your coaching, we talked about valuation. There were others. Risk and reward was something that you feel isn't maybe as quantified as it should be often. Say more.
So I think, one of the common things I see with newer independent sponsors is they over-index themselves on models, right? So, hey, if this grows at X and then we can improve margins by Y, suddenly EBITDA is going to grow by Z. And they kind of look at that and say, okay, that's the gospel. And in my view, listen, models are a key part of any investor package. They want to kind of look at it. They want to understand kind of how things will go. But really, the way we think about it is much more a set of probabilities of things happening or not happening. And understanding, how does this company respond when things don't go the way you think they are, right? If everything's up and to the right and margins improve, listen, everybody's going to slap high fives every single time. And we all know that's just not the way the lower middle market works. And so the ability to kind of say, okay, well, if you lose customer number 2, who's 22% of your revenues, what do you do, right? Well, hey, it might be as simple as there's another customer who can kind of swap into that excess capacity. But it also might be, hey, we probably need to build or reduce our capacity to save costs. So having the flexibility of thinking through both when things are going well and what does that look like and everybody gets super excited by, but what happens when things don't break exactly right? And what are you going to do? What levers are you going to pull in the first, let's say it's the first 6 months of ownership or first year of ownership, where if things aren't going exactly the way you want, how are you going to course correct and fix those problems to allow for a resumption of that growth curve? I think that's really important.
Bobby, every deck that we get from an independent sponsor raising for their deal here at Minds Capital, of course, it has the risks slide or slides, and how they're going to mitigate those risks. Of course, it has a downside case in the model, but you're talking about something more than that. You're talking about gaming out certain possibilities, or what more than we see in what I just in the materials of a deal. Do you press your sponsors to do?
Yeah, no, I think it's more than just putting Excel pixels on an Excel sheet, right? I think anybody can do that and say, hey, revenue is going to fall 5%. That's kind of easy, right? Any introductory analyst can do that. I think really what it is saying, okay, let's think through the next 2 years. What are the risks that we see that could, impact this business to the negative? And so you list those out. Those are your typical risk factors. But now the next step is, okay, well, if those happen, let's presuppose 1 and 2 happen. Well, what are we going to do in that? So it's almost designing the game plan such that when you see some of the breadcrumbs of those things happen, because it's usually not it happens one day and suddenly the world's changed. Usually it's a slow move towards one direction. As you see those things happening, how do you prepare for that? You almost have a game plan set in place where you say, hey, if this big customer is going to leave, maybe it means that I have to do a RIF. Or it might mean, hey, if customer or if we have margin issues because raw material costs are up, maybe it means we need to go back to our primary suppliers and say, rather than have 3 suppliers, we're going to shrink it to 2, and we're going to incent you with volume, but you give us price reductions, right? And so those are just examples I've been dealing with right now as we deal with the Chinese tariff dynamic. But it's just having those stories and that game plan almost set such that when you start seeing things break, you're prepared rather than sitting there scratching your head saying, oh, I'm going to hope that this gets better, because as we all know, hope's not a strategy.
Bobby, how did you incorporate the threat of the tariffs into your underwriting of this deal? And how has that matched what actually is materializing?
It's a great question. And so I would say the threat of tariffs was understood, right? We closed this deal shortly after Trump was elected, but not in office, right? So call it late Q4 of 2024. So we all knew there was some tariff story coming down the pike. What was the magnitude of that going to be? I think it was anybody's guess.
Right.
How did we get ourselves comfortable when you've got, call it 95% Chinese sourcing? The way we got comfortable is by saying 3 things. One, what is the competitive landscape, right? So are all of our competitors in the same boat as us? And the answer to that was yes. Everybody else kind of sources from China. B, how do you deal with the short-term dislocations of a tariff-driven policy? And so what we did both pre-deal as well as post-deal is we invested in a business which had a lot of inventory sitting in their books, sitting in their warehouse. So we knew we could create a pathway where we could go from day 1 of tariffs to day 180 of tariffs without necessarily missing a beat. Now, obviously, if tariffs and the current dynamic last longer, all bets are off. But as of right now, our plan is we've got runway. And then the third thing is we spent time actually chatting with our customers and explaining how we're actually partners in this. There is no quick resourcing from China to Vietnam that's going to happen in 3 months. And so as they think through it, how do they think we share the pain along with the Chinese suppliers? So it's not just one person taking the hit, but it's the entire supply chain as well as the end consumer who's also going to feel a little bit of the pain in the short-term world of tariffs.
Right. And is that also the arguments that you presented to investors during the fundraise for this deal?
It was. And, not shockingly, every single person asked a question about tariffs. And they were right to do that. I think the value proposition on this deal kind of spoke to itself. Again, women's intimates is not a strategic industry. You can believe whatever you want to believe from a political perspective, but the reality is the likelihood of women's intimates ever reshoring back to the United States, I think, is effectively zero. It just doesn't make sense for us to manufacture that in the United States. So at some point, somebody much smarter than me is going to kind of figure that all out and kind of create the right incentive mechanisms in place. And so our view was, are we girded for the short haul by buying right, structuring right, having the necessary liquidity and the right balance sheet to work our way through a 6 to 12 month process with the view that long-term, it's got to get itself figured out. Otherwise, there's going to be bigger problems in our economy anyway.
So you talked about risk reward, right? And so this was clearly a risk. It was well communicated. It was proactive. Nobody quite knows the magnitude of the risk. You still don't know how long we're in it. How do you think about runway in a situation like this? Because this is what I would call a pretty orange flag when you go into a deal, if not even a red flag, that could really dramatically alter the outcome of the investment. But here you guys nonetheless went ahead. So What was the right buffer, or do we still not know perhaps? But how do we go about thinking about that when we nonetheless get comfortable with an orange flag?
Yeah. So, listen, it is an orange flag. There's no ifs, ands, or buts about it. It is something that we thought very deeply about as, again, thinking about it probabilistically. We said, okay, well, there's some probability that Trump and the administration was all bluster and this tariff thing was not going to happen. That clearly didn't turn out to be right, but there was some probability that was going to be the case. There was some middle ground probability that said, yeah, it'll be kind of similar to the first term where he adds certain tariffs and lots of exceptions and, you can kind of work your way through. So that's a second characteristic. That didn't happen. And then the third kind of bucket was, well, what if it ends up in a trade war? And so the way we thought about it was, he said, okay, well, there's some probability there's going to be some trade war. To us, the biggest benefit we saw was we were inheriting a balance sheet that could allow us to withstand, a period of time, right? And I think, I'm a simplistic guy, right? It's very difficult to buy a deal or do a deal and have runway for 3 years, right? Like it's just, there's no deal that'll ever be done where that's the case. So we kind of said, okay, do we have the runway to kind of manage this company for 12 months? And with the right leverage profile, as well as the right inventory story, as well as kind of the right partnerships within our supply chain, we said, yeah, we can live to fight another day, keep our lenders happy, keep our investors sated, to allow for a successful transaction. And if it lasts 24 or 36 months, then yeah, we're going to have some restructuring or something to figure out. But just the reality is that felt like a relatively small probability event. And it was a risk that we were willing to take with the view that this was a as you pointed out earlier, a market leader in a space that candidly is not going away.
Is this a deal that you would say is in recovery mode now because that low likelihood downside scenario already played out? Or is it still transitory? Or how do you think about it as a sponsor when you come out of the gate and this hits you,
Yeah, so I would say it is right now a strong story, candidly, because a lot of our inventory is going to get converted to cash. So we're going to be in a very strong liquidity story. But that story can morph. So if you ask me today, where are we? I would say we're doing very well. But if you ask me in 8 months, I think that answer could be very different based on we're almost taking a little bit of a bet that says, okay, well, this is going to get itself figured out in 2025. And if it does, we'll be okay. But yes, if it's a long term, then yes, it will be a recovery. We're going to have to figure it out somehow. And a lot of our partners are going to have to help us think through, meaning our customers and our supply chain partners are going to have to figure it out. And we've already started thinking about resourcing to other Southeast Asian countries. But as everybody probably reading the Wall Street Journal knows, as the argument is made, those moves overseas to different countries from a supply chain perspective aren't made overnight. And so this is just going to take time to execute upon.
And Bobby, the bet you're making is that your inventory will get you through and you'll hold your breath and just come up on the other side. Yeah. Okay. Just being clear.
Yeah.
And you also pointed out that the competitors are in the same boat. So as long as the underlying market, and in this case, females in the United States needing to buy underwear doesn't go away, it's going to have to come from somewhere. And all the competitors are sourcing it from China. So in the interim period now, and if in fact there is a change from China, they all have to figure it out. And you can simply try to be best on the blocking and tackling. And in fact, it could be an opportunity to grow market share.
Absolutely. It can be an opportunity to grow market share. We have really good long-term relationships with folks who are current suppliers who have shown a willingness to say, hey, I might want to go invest in another Southeast Asian country. And so relying on those partnerships and those long-term relationships is kind of that next stage of what do we do, right? So we're past the initial, our hair is on fire, to now a situation where we're saying, okay, well, let's almost gameplay what the next 6 months can look like and how do we course correct as we kind of go.
On a go-forward basis, if you're faced with binary risks like this again in a deal that you're about to close, will you approach it differently next time?
I would say no. I would not approach it differently. I mean, almost every deal done by an independent sponsor has some element of a binary risk to it, candidly, right? Whether it's customer concentration, whether it's supplier concentration, whether it's key man risk, whether it's, some old equipment that you're hoping is kind of strung together with chicken wire and and duct tape, whatever it might be, there's always some kind of existential threat to one of these businesses. So candidly, I think this is just right now front and center because it actually transpired. But every deal I've ever done has some element of this, and it's all about how do you kind of protect yourself on the downside when those things inevitably do happen.
Bobby, you had a great line that everybody wants to build a car, but sometimes a fast horse will do the trick. What did you mean?
Yeah, it's an axiom I use quite a bit, and it's something that you see a lot with CEOs, management teams, and candidly independent sponsors. And the theory behind it is, everybody kind of walks into a transaction saying, okay, well, we're in, the 1990s, and I'm going to use technology as an example because that's the most tactile. But everybody's, these lower middle market kind of, metal benders or whatever it might be, kind of are in the 90s in terms of technology. And what you typically see is that strategy is, all right, we're going to go in and we're going to do these 7 things to kind of get them from where they are today to kind of the cutting edge of where these businesses trade. And right, you read all of these consultants and, talk to a bunch of business school people and they're like, well, you got to do all these fancy things and kind of give them CRM systems and ERPs and all this stuff. And my view is, I think that's a total mistake. I think, my fundamental underlying belief on doing deals in the lower middle market, which has evolved a little bit over the last, call it 10-ish years, is that taking a business from the 30th percentile of success to the 60th percentile of success is far more impactful than somebody who's at the 90th percentile of success and take it to the 95th percentile of success. And so as I think through independent sponsors and the types of deals we do and the types of deals we do at Salt Creek, really getting these businesses kind of up the curve in terms of whether it's technology or it could be processes and procedures, it could be KPIs, it could be, it's a whole host of things. But rather than have that 50 element dashboard, let's focus on 4. If we get those 4 right, that's 80% of the game. And what I see a lot of people do is they try to do too much too quickly. And what that ends up doing is breaking businesses, right? Because the culture, the people, the systems, the infrastructure aren't built for that 90th percentile company. They're built for a 30th percentile company. And so you got to move that needle slowly. Now, does that mean in 5 or 6 or 7 years you haven't got that trajectory? Sure, obviously, but out of the gate for that first 2 or 3 years, our view is don't, try to build a car. What all you need to do is fix a couple of things and then wait for those to succeed. Show that success and then move on to the next thing rather than try to do everything at once.
And so, Bobby, is the prescription there, just to get a little more tactical, stack rank the improvements to make in this business, and then, choose the top 3 that can 80-20 it, and then, put a line through the rest or crumple up that piece of paper and forget about it. Like stack rank them first of all, and then just focus on the very top, and you're not allowed to look at the rest sort of thing until you get these top 3 done. I'm being overly descriptive here, but something to that effect.
I mean, as simple as that sounds, that's exactly what we do. We stack rank our initiatives. And when we stack rank them, one of the biggest criteria, the 2 biggest criteria is probability of success and speed, right? Those are the 2 most important things, right? So even if it's not the biggest mover, having some wins, some early wins, and having having a quicker time frame to show those wins kind of manifest itself in the company's operations or the financials goes so much further than saying, all right, there's this huge project, it's going to take me 3 years, but it's going to transform this business. Almost never will I say that's the right strategy. 3 years from now, that might be the strategy, but today, let's go fast find the things that can really move the needle, but that can be executed quickly and efficiently.
I've heard you say, taking a company from the 30 percentile to the 60th percentile. We had talked before a little bit about where the most reward for value creation can live from what from what X percentile to what Y percentile for independent sponsors in particular. Do you have that dialed in? Is it in fact 30 to 60? Is there some sweet spot there that we can really kind of put on the scale of you're taking a business from one grade to another, and then that's when you should exit?
Yeah, so I will say yes, but with a caveat that it's not in this 30th to 60th percentile, but the way we kind of view it is it's a little bit of a zone skipping argument of scale. So as you guys know, in the financial markets and in private equity in general, scale creates value, right? So when you're an independent sponsor, typically the profile is one where you've got a smaller side business. And so how do you create value? You obviously grow EBITDA, you make it better, you do all the right things for the business. But then for us, where we've seen the biggest bang for our buck is getting it from certain boxes of EBITDA or size to that next level up. And so just to kind of be a little bit more specific, what I would say is for the independent sponsor world, I think at Salt Creek, we categorize things into 4 boxes. So there's kind of a sub $2 million EBITDA box, there's the 2 to 5, there's the 5 to 10, and then there's the north of 10, right? Once you start getting into the 20s and 30s, that's just a different world I'm not going to bother talking about. But when you're talking about a 1 to 2, and we put our plan together, our view is you're going to get more multiple arb getting that from 2 to 6 than 2 to 4. And so our playbook is always, well, how do we get it up 1 or 2 zones? Similarly, if I've got something that's doing 3.5 of EBITDA, our goal is, well, how do we get it to 7 or 8? Because yes, it grows a little bit, but you're not going to get as much multiple arb if you're only adding $1 million or $2 million of EBITDA. So if you're looking for those home run outcomes, what we've seen over and over again is the buyer universe, the lender universe, the management kind of attracting talent universe, all of those kind of have breakpoints. And as you kind of zone skip up, those breakpoints manifest themselves for you, at least as an investor, in higher multiple arbitrage on the back end. And so we really put our game plans together to say, yeah, it's doing 2 and going to 3 would be good, but if we can get it to 5, that's where we really hit it out of the park.
So it would seem that there's a certain magic at the very bottom end of these zones, because if you can tip in there, then you get rewarded for that, for unlocking that buyer pool. So in other words, it would be 11 million of EBITDA because you're just into, 10 or 11 because you're just into that category, 5 or 6 because you're just in, 2 or 3 because you're just in. So so thinking about terms, is it, targeting 2 or 3 or 5 or 6 or 10 or 11 is kind of...
You joke, and I say this a little tongue in cheek, but literally I've told CEOs, get to 5.1. You get to 5.1 and that's going to change your story. You get to 10.1, that changes your story and how you're treated by investors, how you're treated by investment bankers, how you're treated by the leverage market, because all of these people have mandates sitting in the funds they've raised, right? And so, 10's an easy one that everybody kind of understands, right? You hit double digits, suddenly a different profile of lenders opened up. A different type of executive might be interested in joining the company. The number of buyers who say, hey, I just don't want to do sub $10 million EBITDA businesses is up there, right? So it just changes. So we're even more laser focused than you just said at 5 to 6 or 10 to 11. We're kind of like, how do we just get it slightly over? And then suddenly the market is a very different market.
How does that relate back to the percentiles? I get the size argument and the dollar amounts, but when we talk about 30th, 60th, and 90th and 95th percentile, how do the two combine?
Yeah, I mean, obviously it's a correlated line up and to the right. The bigger means more successful. I think it's hard to just make that general correlation though, because when I talk about 30th to 60th percentile of success, I'm also talking about how good is their data integrity? how built up is their management team? How, and that's a little softer. That kind of comes in to effect when you're kind of going into the marketing process. A PE firm will look at the SIM, they'll look at the numbers and say, okay, this is doing 10.3 of EBITDA. Okay, now great. This is a deal I can now chase. Now they're going to evaluate the soft factors, which is kind of my parable of 30th to 60th percentile of success. And there's a lot of factors that go in. So they're kind of interrelated, but they're also somewhat separate in my mind.
So I was looking at a deal earlier today. It was advertised by the broker as 1.5 million. And then the searcher found out it was in fact 2.7 million of EBITDA. The owner is 83 years old and checked out and doesn't really want to spend time on exiting here. What kind of percentile do you suspect a business like that is in?
Probably the 20th percentile of success, because what you found is you found an owner who candidly doesn't even understand his financials, right? What does that tell you about the rest of his business? Yeah. Probably not good things. So maybe they've found a diamond in the rough and we can go put in the best practices to get that business up. But my bet is you're starting from a pretty low level of sophistication and doing a little bit to kind of get the numbers just right and hardened will probably just create a lot of value out of the gate just on that axis or that vector.
Bobby, we talked earlier about in this conversation how you have closed 10 platforms in your 4 years as an independent sponsor. This is monumental, I would say. And I'm curious, how do you manage that many processes? And we all also know that for every LOI you're able to close, there are many that didn't get to the closing table. So, what kind of CRM do you use? How do you allocate your time? How involved are you post-closing in order to chase the next one? When is enough? I have so many questions. I would love to hear more.
Yeah, no, it's it's a fine dance because obviously there are limited hours in a day. And I think 10 is a lot. And candidly, as I started approaching this number, sitting on 10 boards is, a lot to do. And so that's kind of evolved into my current role where I'm working with other talented sponsors and independent guys who are kind of earlier in their career. But yeah, so, I would say there's probably 3 different things I leverage. One is I leverage the Salt Creek ecosystem well. And so Salt Creek, I think, is very well organized to allow for the high leverage situations to be an area where I can add value. And the things that are a little less important and not unimportant, but things that I don't need to go through a quality of earnings and understand each adjustment to the nth degree, right? That's something a talented person at Salt Creek can do and then come to me and say, hey, we think this is mostly good. And so suddenly I've now shaved what a typical independent sponsor would spend a day focusing on. That day is saved, right? And so just it's a level of efficiency. I would say that absolutely there is a dynamic where as you're balancing portfolio company responsibility and new deal activity, one of the things I've leveraged, again, somewhat with Salt Creek, but also with my own network, is hiring or working with talented operating partners who are not your typical operating partner at kind of, private equity firm 101, but guys who kind of are roll up your sleeves, fingernail or dirt under your fingernail types who can go and just be a consigliere for the CEO. I find that's a big value add. And CEOs of my portfolio companies, I think, really value people who have kind of lived there and done that. They like the private equity guys as well, maybe not as much as the operators, but they like the private equity guys. But somebody who's kind of been a CEO before and able to kind of break bread. And, sometimes it's like, well, what do I do when, my number 2 wants to quit? Or what do I do when my landlord is unreasonable? And having some good conversations with people who've been through that, I think is really important and takes a lot of some of those, daily or weekly conversations off my plate would be the second thing. And then the third thing I would say is in this new role where I've got really talented deal makers who I work with, they're kind of what I would call the deal quarterback. And I'm there to kind of help them kind of continue to grow in their career. And it gives me leverage. It allows me to say, I can help in all of these places, but ultimately this is a world where the School of Hard Knocks wins. And these guys are kind of going through the schools of hard knocks, which I think is a great way for those guys to grow in their career. But then they've got kind of a fail-safe when things really start going poorly, and they have somebody like me they can bounce their thoughts off of, their ideas off of, to allow them to then say, okay, how do I react in a tougher situation where I don't have the right experience set?
To double click here a little bit. So 10 platforms, 48 months, that's a closing every 5 months. So do you have multiple LOIs at the same time? And when you have 1 or 2 LOIs, how do you decide, okay, I'm going to allocate 40% of this week, 2 full days, to sourcing even more deals? Or how does that conversation go internally in your head?
So at any given time, it would be very rare where I don't have at least 1 to 2. Today, just sitting here today, I've got 3 LOIs out there. I think all 3 will close. And so that's a pretty prolific pace, I think. All are with, another kind of Salt Creek person taking kind of the lead. But, as I think about it, right, there's probably 2 or 3 time frames within a 60 to 90 day period where my value is probably highest. One is kind of in the initial kind of get it signed under LOI, negotiate, right? And then there's a bit of a pause while we take in a bunch of diligence information and digest it, where I can kind of double click and do something else. Then you get that information. The second phase is kind of when you're getting your third parties and your lenders kind of processed, right? So it's synthesizing that data, creating value out of that data that we've created, and then utilizing third-party providers to answer the key questions. So that's the second time where I tend to be pretty busy in a deal process. And the third time is as you're kind of ratcheting towards a close, usually unforeseen things pop up, painful dynamics around whatever it might be, management, employment agreements,
right,
or the skeleton that, everyone was kind of hiding, the various things, those kind of tend to rear their head when you're kind of 15 to 20 days away from a close. And so then you, again, as a third time, that's where I kind of have to prepare myself to spend real time. And so, but in between, it's a lot of the team really pushing the process along, and I can kind of spend my time doing something else.
Of the 10 deals, approximately how many came through a banker versus proprietary?
So I'll answer that by saying 0 are what I would call truly proprietary. I'm just a believer proprietary deals are very hard to do. If you can get them, amazing. You are a better man than I. I think intermediaries are an important part of this world. But when I caveat it, what I would say is those intermediated deals tend to have some story to them, right? Whether it's a broken process, whether it's, a very small buyer, appropriate buyer universe. A lot of what Salt Creek does is we partner with management teams or CEOs who are well-versed in an industry, and then we'll drop them in as the CEO, right? And so if you think about the world where owner who's 72 years old wants to go play golf in Florida, the number of private equity buyers who are appropriate for that business is very small. And so how do we differentiate ourselves? If we have an operator who can jump into that helps. And so those are the kinds of tenets to the transactions we can get done. They're not down the fairway growing, 20% with all these superstar managers. Like there's always a bit of a story to all of them.
But I wasn't actually going to go in this direction, but since you opened the door, all your deals have been through intermediaries. There are plenty of people in the independent sponsor space who will say that you should never participate in, broker deals, and that your best way of adding value is by finding deals off market. So you're taking the exact 180 stance to that.
I think it's very difficult to find deals that are not somehow intermediated, right? And so when I say that, what I mean is we all know there are some, and I'm not going to, I can name it, if it's a Baird process, the reality is Baird is a really good banker who pretty much knows everybody in the market. And there's lots of peer groups to a firm like that. those are going to be very difficult for us to do. So when I say an intermediated deal, I'm not talking about those kinds of deals, but I'm talking about the lower middle market broker who may do 5 or 6 or 7 deals a year at most, maybe only 1 or 2, is looking to kind of put together a transaction profile that fits a lower middle market kind of buyer, right? If they're going to try to go out to the $500 million funds or the $1 billion funds, chances are we're not going to win anyway. So there's really not a lot of point for us to compete in those processes. But where there's some kind of dislocation or some story, that's where Salt Creek can differentiate itself. We can bring this management story to the table. We can bring our experience to the table. We can bring heightened level of senior attention to the deal, whatever it might be. But why do people focus on the lower middle market? One of the reasons they focus on the lower middle market is because there is some inefficiency. There is some ability to kind of have value, things other than price drive a story. And that's kind of where Salt Creek lives and breathes. And that's kind of how we get transactions done.
Bobby, if there are sponsors listening who are interested in the value prop of Salt Creek or working with you, is that something that you invite outreach that way? Should they raise their hand, getting connected with you? What?
Yeah, no, we're always open to forging connections and talking with the right people, right? It might be as simple as, hey, I think what you guys do is pretty interesting. I just want to be an investor. Fine, that's a very simple way to kind of learn about us. It could be, hey, are there situations where we can co-invest as a firm with you? Okay, well, that's, maybe we look at things differently. And that particularly is interesting to us when they bring a unique differentiated perspective on a sub-industry that we might not know as well, right? They might have an operator, they might have a previous portfolio company in that space, whatever it might be. But if they can bring that extra layer of intelligence to help us as a independent sponsor, great. So yeah, we're definitely open to chatting with people. You can go to our website, you can find my contact information there. And we're always open to having conversations with value-added sponsors and investors and other folks who we think will be valuable to our processes.
Well, thank you for having a conversation with us today.
Absolutely.
Bobby Sheth of Salt Creek Capital. Thank you very much.
Thanks, Will. Thanks, Nicholas.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.